You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from the Moose on the Loose. Happy Thursday, where we will end our quick series on what 2025 has in store for some of my favorite stocks. Of course, I could have gone on and on and on like several companies. Today, we're going to talk about materials, utilities, and we're going to end this episode talking about Telus and Granite, two of my non-performing companies in my portfolio as of late. And I'm sure that some of you are sharing the pain. So is it time to let go? Is it time to keep or double down? Let's take a deep dive. First, material stocks. Ironically, I have like two companies in this sector, but not the typical gold, mining, silver, copper type of companies. Two interesting stocks before I talk about mine, though. I would have an eye on Franco-Nevada, mostly because this company has no debt. It's a gold streamer, so it has less risk, and there's an interesting upside potential if they ever come to conclusion with the Cobre Panama mine that is being closed for a little bit more than a year now, which is affecting, of course, their financial statements. Another one that could be interesting to look at would be Labrador Iron Ore for this year, especially because the iron price has gone down deeply. So the stock price gone down, the dividend accordingly, because the company is paying a variable dividend according to iron price. So if it goes up, everything goes up. If it goes down, well, you know the song, right? Not for the faint of heart. You must understand the business, but those are two streamers, the Franco-Nevada and Labrador Iron Ore. Could be interesting if you want to have like those typical plays in materials. On my side, I have a lumber company, Stella Jones, making utility poles, railway ties, and residential industrial lumbers. I've talked about this one a few times. Going in 25, there's a lot of uncertainties, especially around tariffs. I'm actually not that worried about it at this point, mostly because, yes, they do have about 75% of their business in the US, but they do have a lot of manufacturers over there too. So they may just move their business and their activities in the US. They're already well established, and they could skip a lot of tariffs this way. So even if it comes into play, maybe Stella Jones is well equipped already to face that threat. Of course, it's not going to be an amazing year, but that's when you have great opportunities, is when the stock price is a little bit weaker and when investors are running away from great companies like this. Another one in my portfolio, CCL Industries, specialty packaging in food and beverages, in the healthcare sector. Like two of those two segments are like about like $1 billion in sales each. Very interesting type of like business model where there's a lot of repetitive products. They grow by acquisition. They are doing business in North America, in Europe, in Asia. They also count on Avery, which are making like RFIDs and labels. So that's another place that they can grow. They went through the phase where they had to pay more for their raw materials. So for inflation, now it's under control. They have been able to show resilience and ability to improve, to maintain their margin. So that shows some pricing power over here. And I expect that CCL is going to do a good job in 2025. Even if there's an economic slowdown, most of their products are still going to sell, especially in the healthcare and food business. They're kind of like related a little bit more to consumer staples than consumer discretionary. So it's going to help them going through any rough patch. In the meantime, I'm a very happy shareholders of both Stella Jones and CCL, and I'm willing to wait a few more years before I can smile even more, especially for Stella Jones, that is not doing much right now in my portfolio, but that's part of the game of being an investor, right? Another sector that could be quite interesting in 24 and 25, sorry, as the interest rate has gone down in 24 and a few more interest rate cuts are expected in 25 is the utility sector. So I do have Fortis and Brookfield Renewable. The reason why I think it's interesting is because over the past 2 years, between like 22, 23 mostly, a lot of income-seeking investors started to sell their high-yielding companies and going back to their GICs and bonds because they were offering a nice yield. Now that it may not be the possibility anymore, we could expect to see some investors going back to stocks, going back buying some utilities. We have seen that in the past, and this is a great opportunity for those companies. Again, those are supposed to be boring stocks, not generating much return. I see them more like the Deluxe bonds, which are like companies that are relatively stable, paying a good dividend with constant dividend increase, which is exactly the case for Fortis and Brookfield Renewable. And I'm not trying to play the trend on renewable energy, but rather invest in a long-term asset manager that invests into hydroelectric plant, solar panels, and of course wind farms. Moving on to the last section, trying to make that within 10 minutes. I think I'm going to make it. Telus and Granite. Absolutely nothing in common, but besides the fact that they are poor performers and they pay a relatively high yield in my portfolio. So if I look at my overall portfolio yield, I'm closer to 175 to 2%. So very low yield, high growth type of portfolio, but I do have a few companies paying a higher yield. And Telus is definitely my highest yielding stock. I've been holding this one for ages, and I mean, it was a good move for a long time. Over the past 2 years, not so much. One problem: interest rate keeps on creeping up, so interest charges like affected Telus big time. I guess that the bad results from BCE is also affecting the overall market, so a lot of investors are like just avoiding telcos. Cannot blame them. There's a lot of like negative headwinds. The slowdown in the immigration policies will also reduce the number of people needing a cell phone. So therefore, Telus will have to find other growth vectors. What I liked in 2024, and I expect that to continue this year, is the improvement from the cash flow situation. So higher free cash flow, higher cash flow from operation, and lower capex. So spending a little bit less, making sure that the dividend is covered by free cash flow. As long as those metrics are good, I will be holding my shares. But again, it's all about the numbers backing up my story. So far, it is good. Another aspect that will be quite interesting for 25 is the update on the dividend growth policy. So they increase their dividend by 7%, like two increases per year for several years, but that stopped this year. So now we're up for a new a new policy. So I really want to see that. I'm very curious about it, and that may have an impact also on my decision of keeping those shares or not. But for now, I'm not worried. I'm just gonna hold on to those shares and see how it's going to turn out. As for Granite, oh my god, this one definitely, and I've qualified it on the show, my most frustrating stock to hold. Why? Because the company has a compelling story. So the investment narrative is pretty strong. I mean, industrial company focusing on e-commerce, on warehouses, highly specialized, growing. The funds from operation is increasing. The FFO per share is increasing. The dividend is increasing. I mean, the only thing that is not increasing actually, it's the stock price, which that's why I found it so frustrating. I get the concern around Magna International and their high concentration in terms of tenants. It's about like 26-27% of their revenue are coming from Magna International. So what's going to happen there? I mean, like Magna is not going to go bankrupt anytime soon. It's not like super performing, but it has been relatively stable over the years. I'm not expecting them to close like 10 properties and let Granite get stuck with those. The occupation rate is at like 94% or something like that. So I don't really see a problem here. So I'm going to hold on this one, be very patient. And that's about it. I mean, sometimes when you invest in companies, you have to be true to your investment strategy and hold on to those companies and be patient as long as the numbers are backing up your story. Finally, we just updated the dividend rockstar list, so you can download it at moosemarkets.com/rockstars. If you're already on my mailing list, you will receive the update this Friday, so don't have to worry about it. But if you're new to the show, go to moosemarkets.com/rockstars, subscribe to the newsletter, and then download the Rockstar list for free. The Rockstar list is a list pulled out from our Dividend Stocks Rock Screener, showing companies with positive revenue, earnings per share, and dividend growth over the past 5 years. So it's a great start to look at great companies for the future because they already show robust financial metrics. All right, Moose, that's enough for today. Tomorrow, we are doing some kind of like a little bit of special. We're going to have a Retirement Friday episode. So more on that tomorrow, but don't forget to subscribe to the show. Give me a 5-star rating if I'm adding any value or just a smile during your day. And we're going to talk again tomorrow. In the meantime, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.